Started. So welcome everybody to the transfer pricing webinar. My name is Ryan Gore. I work with Briggs Veselka and I work with Josh here as well. A few housekeeping items before we get started. Number one, you are muted during this presentation, but if you have any questions during this at all, there is a Q&A section at the bottom of your screen. Please submit any questions there, and then Josh will be able to get to them at the end of the presentation. This session will be recorded, and we will send out the recording and presentation materials to everybody by email after the webinar is concluded. And then if you have any questions, please reach out to us at marketing@bvccpa.com, and we'll be happy to answer anything that you have there. But let's get started. I'd like to introduce Josh Friendfrock. He is a tax principal with Briggs Veselka, and he leads our transfer pricing practice here at the firm. He has worked at PwC and even the IRS, and has spent 16 years helping clients understand the complexity of transfer pricing and how to achieve tax savings, as well as remaining compliant in the eyes of international tax authorities. So he's got a great presentation planned for you all today. And with that, Josh, go for it.
All right, thanks, Ryan. Make sure I'm on the right, there we go. So I guess we've covered the intro there on me, and you guys are familiar with Briggs Veselka at this point. So I'll kind of jump into our agenda. Not knowing the full level of people's familiarity with transfer pricing as far as the attendees, I certainly want to start with a little bit of an intro, and then maybe some examples of just typical types of transactions that we're looking at, just so people are on the same page as the kinds of things we're thinking about, looking at, and that'll be helpful. The other thing being, given that we're going to talk about some of the current work with the OECD, I think a little bit of background to set the stage for that is going to be necessary, even though some of that's a little bit dated information if you're very familiar with transfer pricing. Certainly talking about what the U.S. has done in response to some of these things, and other items around the U.S. will be of interest, and then we'll get to this OECD stuff kind of at the end. And that's probably what a lot of the chatter is these days in the marketplace and around transfer pricing and around the world. So we'll get started here with, what is transfer pricing? I mean, what we're dealing with on a day-to-day basis is always going to be a group of companies, a related, controlled group. And wherever that group is going to operate across multiple taxing jurisdictions, I mean, that can even be domestic in a state context or provincial, but typically we're working in an international context where we're moving goods, in a supply chain, doing services, licensing intangibles, making loans, these kinds of things across borders. So taxing jurisdictions, the IRS, and most of the authorities around the world are very keen to keep their eyes on transfer pricing because we control the pricing and the accounting of what we move those transactions at. There's opportunity to shift profits from the government's perspectives, and they're all interested in making sure their tax base is protected. And so everybody has rules and enforcement around keeping that in the boundaries they think is reasonable. What we're really based on, almost the entire world, except for a very few exceptions, are off this arm's length standard concept, which is the concept of we acted together in our controlled context, the same as we would have were you completely independent as a vendor or a partner or something like that, where there was no control. So in a U.S. context, our rules are coming out of, our guidance is really coming from 482, the Treasury regulations, and our requirements and penalty coming out of 6662. We'll get into that a little more later. And then certainly most of the developed world, and really by now almost everybody around the world of economic significance, has some level of requirements. And a lot of them do look to the OECD's guidance, whether that be formally that they just sign on and say our rules are the OECD guidelines, or that they mirror some of that. That's where most of the world is looking. So the IRS views the US rules and the OECD guidelines as materially similar. There are differences and certainly different language and different things in there, but materially similar. So that's kind of how we operate. So to get into just a few examples to give you some context as we get later into this, one of the things we see the most of are going to be tangible goods type transactions, right? So the supply chain, it's very commonplace, obviously, in our global economy for companies to be making things. Maybe they're extracting part of something in one place and sending it to another place to make raw material or make parts or make a finished good. And those products move to markets all around the world. So there's a lot of crossing of borders, and that the sale of those goods or anything of those, that it can even be production assets or other things like that. But that tangible asset, tangible goods transaction across the border, that pricing obviously has a lot of impact on certainly the distribution return and the tax base that's going to be in the country where the distribution is happening or where a manufacturer may be. So everybody in that chain has interest that those prices moving between the entities are arm's length. The other area that is very common, and most international groups are going to have some form of this, is intercompany services. And this can be from the basic low margin, low risk areas of, our headquarter level has HR people or tax people or a legal department, or things that we view as a shared resource that all of our subsidiaries or a region of our subsidiaries look to for support. So everything in that context, all the way up to maybe even entities that are fully functioning as one type of service provider. Maybe it's an R&D entity. Maybe it's an entity that does installation or some kind of on the ground customer support or maintenance, that kind of stuff. So the technical type of services. So you'll see that in all kinds of forms, whether it be the parent allocating out cost of services that they do to support, or subsidiaries being captive service providers on behalf of a principal or another entity, as well as just people. Global companies hire people all over the place, and people's roles end up being hired in one place and supporting a global group and benefiting everybody. So how you allocate and share that cost around, those deductions around, is obviously of interest to tax authorities. So intangible property, you see the lists up there, the technology, marketing type things. This is really the area of probably the highest interest to the global tax community right now, I would say, because any kind of company that's making a significant profit, a lot of that's going to be tied to non-routine activities, which is going to be whether it's that they've developed some kind of patent, some kind of well-known brand, whatever it may be, the secret sauce, who created that value, who owns it, and who's using it and exploiting it in the marketplace. Those all play into a significant amount of where the profitability of a global group falls. And so that's where tax administrations are very keen to have an understanding of a group and what entities in their country are doing and not doing, and who's getting compensated for sometimes these very significant portions of the profit. So, that can be moving. You could be like transferring that asset somewhere, or aligning with multiple entities to share in a cost sharing or like shared development of an intangible. Probably your most day-to-day iteration of this would be some kind of royalty type, right? We've created something or bought something. We have something that everybody else can benefit from. We license that to them. They pay us a royalty. Obviously, the side of that that's getting a deduction expense for royalty is very interested that it's not too high, and the side that developed these assets and probably gave R&D tax credits and all kinds of incentives to develop IP is concerned that they're getting paid enough for their IP. So you have a lot of things to think about there in your structures. And then next, kind of on the agenda, being financial services transactions. And this is, I'm just going to cover a couple commonplace things that get discussed. There's so many types of financial transactions that can happen across borders, and especially if you get into the financial services industry itself. But even across any industry, you're going to see intercompany loans probably be the most prevalent thing, or leasing of some kind of asset. So we see a lot of that regardless of industry. And this is another area that's very high on the priority list for tax administrations to look at for non-compliance, because again, certain of these kinds of things with loans and that type of thing, you could move a lot of money around without moving a lot of stuff around, right? That's why it's of interest, is it's higher risk for moving, loaning a bunch of money somewhere and getting deductions in a convenient location and income in a convenient location, right? That's I guess at least the suspicion that we operate against. So there are rules and guidelines around how to do that properly, from how to make sure the rate of interest is correct and the amount of debt might be correct, and that authority is even going to view it as debt. And we'll get into that a little more at the very end. So why is transfer pricing important? This is kind of a quick run through reasons why people end up calling me, why they want to think about this. I mean, obviously the cost savings is the most exciting thing, right? If you can utilize transfer pricing in the right ways to go alongside your business people and say, hey, there are options within how we could do something that optimize our global rate, whether it be our income tax or even the impacts that we may see from customs duties, VAT, other types of taxes, digital services taxes. We're going to see some stuff about that later, obviously in more detail, as well as, of course, companies who can save money by being more efficient how they manage cash, maybe how they do financing for their group, because maybe they have cash-rich entities and cash-needy entities, and borrowing money from different banks may not be the most efficient way to do that. So that's certainly an area. The other piece that a lot of CFOs and controllers and tax directors are thinking about is this risk management piece. So certainly with the amount of deals happening in our climate right now, due diligence readiness is a huge deal, especially for mid-sized companies, but all the way up into very large companies, because even if a company is maybe overlooked it or not viewed it as a high-risk area until recently, they get into due diligence. I can assure you CFOs don't like to learn about transfer pricing in negotiations on a deal, right? They don't want to find out that there's something they didn't know about. So I think that's probably the biggest risk management piece for most people. The fundamental risk in transfer pricing is double taxation in a theoretical context, right? Because if you get an adjustment on one side, one tax authority says, you took too much deduction here, or you didn't have enough income here to be arm's length, so we think you owe us more tax. Well, they're going to be talking about a period that's probably several years ago, right? So you've already paid taxes both places how you thought it should have been, and they make an adjustment on one side. Well, what's the other side going to do? Are they going to give you a refund? Are they not? Is that an option? So the possibility of getting stuck with paying tax really twice on the same dollar of profit is a bad answer, obviously, for everybody, and can be a very time-consuming and costly thing to unwind, even if it's an option to do so. So that's the other area. Obviously, transfer pricing audits are on the rise. I think for mid-sized companies, the foreign side audits are probably happening at a much quicker pace than IRS audits at this point. But the IRS has tended to focus more on these, what we call a campaign. When I was there, there wasn't a size necessarily to it, but there was a type of transaction, an inbound distributor, or companies that set up and did unilateral rulings in a given country, some kind of thing where they're going to look at everybody that did a certain type of activity because it's a transactional type they view as non-compliant. So that's a risk area to be monitoring. And getting into controversy is, again, time-consuming and not a very desirable way to be spending your time and resources. So managing that risk. Again, all in that same mix, when you're getting these adjustments, when you're in these controversy situations or non-compliant situations, penalties can be in place. Some countries have very significant penalties. Some have nominal penalties around non-compliance. Some have significant penalties around adjustments. So it kind of runs the gamut there. We'll get a little bit more into that later. And then lastly, kind of your compliance side of things. There is a compliance side where regulatory requirements to make sure we're operating, within the boundaries of what a government says is okay for them, and proving out to them that we're acting at arm's length in their jurisdiction. So documentation requirements have proliferated significantly in the last 5-6 years, and it's an exercise to its own to even figure out all the places you might have met thresholds, making it relevant for you to comply with those rules. Also, a lot of countries within adding those kinds of documentation rules are adding disclosure forms in their tax returns, where maybe a tax preparer has to sign off that documentation has been prepared, or at a minimum they're reporting all of their intercompany transactions to. So that's kind of giving administrations a chance to know what's happening. And then within that compliance side, there is penalty protection, often by virtue of having compliant documentation and having operating according to the prescribed rules, which is certainly a benefit. All right, so we get into the OECD, which is where we're going to spend a lot of our time talking. I think this background is kind of necessary just to level set. If you're familiar with BEPS, then this will be, something you maybe have seen already. But after the economic downturn in 08, 9, 10, governments were needing money, needing revenue, and there was also kind of a shift in attitude from this mindset of, we want to make sure we're the friendliest jurisdiction to attract foreign investment from a lot of foreign governments, right, from a policy perspective. And that played into tax as well. What really shifted is kind of a perceived situation where really large, and frankly, really large US multinationals in particular, I think were getting this attention, were able to structure their operations legally, but in ways that led to a term called double non-taxation, right? Governments didn't want to have double taxation happening, which discouraged investment. But now they're at this point where they're saying, we want our fair share of the revenue, and we think companies are paying tax nowhere. So we don't like that. And we don't think that's a fair deal. And a lot of that came through the significant globalization, but also the change in the nature of business. Digital business is just done differently. Rules were written for businesses that weren't digital, right? And so how do we appropriately realign our international tax paradigm? So not just transfer pricing, but all of international tax rules, with transfer pricing being a part of that, in such a way as that, we're aligning taxation. What the governments want to see is that where value creation is created, the substance of what's happening is where the profit falls and where it's taxed, right? Because they viewed, hey, we have much more contribution to this process than we're getting credit for. And via different tax rules or transfer pricing, we're seeing all that money get taxed somewhere else, or land somewhere else that may not have a high tax or no tax, right? So certainly the loopholes, that the loophole type discussion, everybody wanted to close down different things where there were just differences that caused easily exploitable planning opportunities. And lastly, the governments felt, especially the smaller countries, they just didn't have enough information to even get in this fight with the big companies. We don't have enough transparency of information to even assess where our risks are, where to allocate resources to do transfer pricing audits, for example. And so that kind of laid the foundation for this BEPS project and this 15-point action plan that was brought out to try and address these general concerns, right? So we're not going to talk about every one of these. Obviously, I think you could probably spend a whole webinar on any of these. We'll focus on the more transfer pricing specific items on this list. I mean, we're obviously going to spend some time at the end on the digital economy challenges, because that's kind of the big current topic, right? But as far as the early impacts with transfer pricing, actions 8, 9, 10, and 13 were the real changes that were really directly transfer pricing. A lot of these have indirect transfer pricing implications, but 8, 9, and 10 being how to align that value creation with the outcome, that taxing authorities felt was fair from a taxation perspective. And those things happen around intangibles, financial transactions, risk, capital allocations, and other kinds of high risk situations, right? So that's what they focused on in those, and we'll go into that a little bit. And then the re-examination of documentation. So a new paradigm of how to do documentation, which at this point is many years into adoption from a lot of places, but we're still seeing countries adding requirements based on this paradigm even today. So it's a continually expanding kind of area of interest. So the action 8 through 10, right? These are like books, right? It's a lot of information. So just to take a little bit of highlight of some of the key things that I think are worth being aware of. A lot of this is setting a framework to revise guidelines and rules with an expectation of how do you delineate a transaction where, okay, you have form and you have substance, legal form and actual reality and substance of where things are, people are, key assets are, capital is, strategic decisions are made, those kinds of things. How do you take that and make sure that, you know, if you have divergence between form and substance, that you have a paradigm to make adjustment to say, hey, we see what you said you did here. Here's what we think happened. This is how we're going to look at this, right? That's a big fundamental part of a lot of this subset of actions, because how risk is allocated is a big deal, and how intangibles are credited is the other big deal. The big concept that came out of this around intangibles is this DEMPI concept. You'll see a development, enhancement, maintenance, protection, or exploitation of IP, because the commonplace structure is to have all your IP in one place, all the credit to one place, and that is much more simplified, and it is accurate in many cases. But I think you saw from a developing world context, from even a lot of the European jurisdictions, looking at this saying, hey, there's local contribution to things that we think should be in the paradigm of intangibles, whereas we're just getting this routine activity kind of credit. And so this DEMPI paradigm, if you analyzed who's contributing these factors across this paradigm, would lead towards more of a shared allocation of residual or high profit margins, as opposed to a winner takes all kind of situation, right? So that's certainly the way the foreign authorities want to look at this, and the paradigm of the future around how to think about intangibles. Funding and risk, same kind of thing. Very easy to set up an entity with limited substance and assign it a lot of risk, a lot of responsibilities, or have a lot of capital there to fund other things. And so one of the things this kind of laid down as a baseline is, hey, an entity with no substance just bringing capital, that doesn't deserve an outsized return. It deserves a routine return. So that's a baseline that impacts a lot of types of transactions when it comes to financial transactions, as well as, you know, an entity that might attract a significant profit because they are perceived as the risk-taking entity. Well, if they don't have the people that are really ultimately in charge of that, they just have assigned functionality, that's where we're going to see scrutiny. So, I mean, from a takeaway perspective, I think the quality of functional analysis and how well we develop facts is a big deal. I mean, obviously the IRS, that's what they spend all the time on, right? Is developing the facts, because these are facts and circumstances driven issues and cases. And we're going to be dealing with a framework where authorities are looking at lots of different ways to do the same thing, which is mitigate what they view as artificial arrangements, and so they can make adjustments and align that value creation and profit where they think it should be and where it really is, so that the tax is fairly being allocated. I mean, that's kind of the deal. So, I mean, ensuring that we're thinking about our transactions with this increased scrutiny in mind is going to be important, especially where there are things that may diverge a little bit between form and substance, or the economic realities of how something sets up. And you get a lot of entities in a structure, and it's really easy for that to happen. It's really easy for it to happen. It's also easy to plan it, but both directions are equally as concerning to the tax authorities. Action 13. So this really recast how documentation was going to be done. The intent was to have a consensus around a increased transparency, but also a uniform format that everybody could get around. Now, of course, the US isn't going to change to do this exactly, and hasn't. And there are other jurisdictions that will be similar to that. But a lot of countries are taking this concept Master file, local file, and country by country reporting. So the country by country reporting is a 750 million euro group size informational reporting disclosure on each country's activities, financial metrics, head count, taxes paid, some of these things that would allow risk assessment to be done. It was the theory behind that, more transparency to do that. A master file is really going to be that kind of the narrative global view, whereas a local file is what I think most people would think of as a traditional transfer pricing study, where you look at one country's transactions, you analyze the facts of what that entity does in the group, look at what kind of methods are available to support that transaction was done at arm's length, and the economic analysis to then substantiate that, right? So that's kind of your local file. The master file is going to be above that at a global level, talking about the whole structure as a whole group, maybe business segments, so that a smaller country looking at a local file would have some context for where they fit into this global group that may be $50 billion, it may be $500 million, right? But if they can only see one side of it and a limited side of it, it's hard for them to understand how to look at it from a risk assessment standpoint. So, I won't spend a ton of time on this, but the context of the master file, again, you can see here is a group level type things, some very particular disclosures and descriptions around global IP policy and financing are probably key areas that came out of this. Other than that, it's mostly, to me, global context, like I said. The local file, again, at a country level, what transactions are we talking about? How are we going to support those? What data do we use to support those, et cetera? That's kind of this local file piece. So we'll have these if you wanted to look back to it, but I'm not going to spend a ton of time there. As far as documentation requirements, what I've done here, obviously, every country has a whole slate of different things, but what I wanted to highlight was a few key examples so you can see the differences of the types of ways different countries are setting requirements, and you could see how they're trying to use this to, the optimal balance of encouraging compliance with giving themselves some stick to apply to the situation to enforce. So Puerto Rico is an interesting one, largely going to look to U.S. regulations at this point as far as what documentation should look like. Now that may change in the future a little bit, but it should be somewhat similar. The interesting factor there is this putting this, subjecting companies that don't have proper documentation to a 51% disallowance of their related party expense deductions. So that's a pretty big stick, if you will, as opposed to the carrot approach, right? And as well as, of course, the tax preparer having to sign off that they've done this. So I think that's an interesting type of requirement. And there are other countries that are doing things like that as their mechanisms for dealing with this issue. The Netherlands I put in next, one of the earliest countries to really get into the Action 13 structured requirements. They followed the 750 million threshold for CBCR, which has largely been globally consistent, and most people have adopted it. But they were one of the early ones to diverge away from that 750 million threshold to a 50 million euro group revenue. So again, they're looking at if this company's 50 million euros or above as a group, we are requiring both this master file and local file if they're in the Netherlands, which is a lot of companies. And a lot of companies have entities, holding companies, investment companies. So there's a lot of companies that this put in play that weren't probably thinking about this before as much. The other thing of note, and this is a concept that obviously is not just the Netherlands, but it's highlighted here, non-compliance, leaving the burden of proving this to the government on the taxpayer versus shifting it to the tax authority if you've done your proper documentation. And that can be a big deal in controversy. China is an interesting one because they've followed some of the OECD form. Now they also have a litany of forms, related party disclosure type forms that go on a tax return in the 25 forms. There's a lot of them. but they set this threshold again, their master file threshold. I've translated these. These are all in local currencies, usually for a given country. I've tried to put dollars so you have some context, but 157 million, right? Well, that's a lot lower than the 750 million that a lot of this started out as. Their local file, whereas the Dutch were tied to the group size, the local file from a Chinese perspective is really tied to localized transactions. So how much intercompany deduction are we looking at here, in or out, or revenue? And so there's a threshold for tangible goods, for financial and intangible assets moving, and then a fairly low 6 million threshold for services, interest, other types of transactions. So again, they're hooking people on how much activity, related party transaction wise, do you have in our jurisdiction, versus the Dutch, where it's just how big are you, right? Mexico, another example here, 33 million in local revenue to trigger some of this requirement of master file, local file. Well, that's not so that's a different threshold. Again, it's based on how big is your revenue size in the country, not how much are your intercompany transactions. Now, if you hit the requirement, you're documenting every transaction above a certain size, but that just shows you where different people are looking. The other concept that you'll see some places, Ireland was like this as well, probably going to change somewhat. The UK may change some of this, but historically this small mid-size exemption for where it may be a 2 or 3 prong hit on one of these things, but an exemption if you're below, as opposed to a requirement if you're above, kind of a concept, but based on head count, revenue, assets, right? So I think that's an interesting place as well. And that's where you'll see, I think we should have more of that globally. The US doesn't have anything like that. Canada doesn't have anything like that. I think it would be helpful, but it's not out there for a lot of countries in that way. So the other thing being these international dealing schedules, which Australia's got. Everybody, I mean, everybody's doing these kinds of compliance. So reporting on this stuff is happening regardless of how much you're documenting the support for it. So that just gives tax authorities more chance to risk assess, look at who they want to spend their time with. And so as this concept goes, the penalty regimes are different as well. Like, for example, just like the US would have, Canada's this way, a percentage of the under tax payment when there's an adjustment. That can be a huge penalty, but it may be no penalty in a lot of contexts, right? Versus there are countries that are actually having penalties, whether it's a fixed dollar amount or up to a fixed dollar amount for non-compliance or late submission of this documentation when it's asked for, or even some countries that are doing a compliance-based type penalty like that, but it's tied to a percentage of the intercompany transaction volume. So the more activity you have, the more penal the system is, right? So that's another type of thing. So again, an exercise in its own right to look at your footprint and understand where you fit. But these are, I thought, a slate of examples of the different types of ways these thresholds are getting put out there. All right, so on time, okay, probably already running behind. The US response, US did adopt CBCR. There was not a lot of intention to go along with this early on. It was the lobbying of large multinationals who realized that these rules were going to get in place in foreign countries, and all these foreign countries were going to individually be requiring these groups to give over this information directly to a foreign country. And that was not a great answer for the really large multinationals. So after a lot of that push, the IRS basically went along with this in a consistent form. And has its own information exchange network now. They will try and control that and safeguard the information, right? Which is why US multinationals wanted the Treasury involved in this process, so that they're sort of a gatekeeper on the US company's behalf, instead of getting a requirement where you're having to hand this out all over the world to who knows who. Of course, one of those limitations would be if it's being shared publicly. So we're going to see, I had to add this morning, literally today, EU announced the adoption of a public type CBCR publishing. So that will be probably a little bit different than the CBCR format. There's also some exceptions and some ways to delay when that information comes out, if there's commercially sensitive information, which I imagine everybody will all of a sudden have. So we will see how that plays out, and if the U.S. decides to do anything to limit its sharing of information on account of the jurisdictions that may be publishing some of this stuff. Other than that, as far as the Action 13, the U.S. did not change its documentation requirements because of this to the master file or local file approach, though the IRS will ask for a master file. It's good information, and most companies are giving it. So, I mean, they know larger companies have it on hand. So, I mean, it's something that's going to get asked for most likely, although it's not the requirement here. So to quickly go over the U.S. requirements, do we need to do documentation? Yes. The requirements are met if you're preparing and keeping these principal documents, which I'll show you those in the next slide. But just to show you quickly the penalties, again, based on how large an adjustment might be in an examination, that would layer these penalties up from 20% to 40%. And you can see how that obviously can get pretty large pretty quickly. And so having that compliant documentation contemporaneously gives you protection from these penalties if this came to the point of having an adjustment, right? The 10 principal documents here, again, if you think about the local file, right, a lot of this stuff's in there, right? But for a lot of US companies, this is already showing a lot of what the master file would show anyway. But we're going to be talking about the specific transactions, how we support them, giving the facts and circumstances, developing the functional analysis, functions, assets, risks of our group and related parties, all those kinds of things. And these 10 items are really what is prescribed. There's also a concept called background documentation, which is going to be all the details, which I can tell you will also be asked for at the same time as this is asked for. So, you know, having all of that is going to be pretty necessary in the examination context. Other changes that have happened with tax reform, there wasn't a lot of changes to the rules about documentation or anything like that, but there was one significant change as far as the definition of intangible assets. Now, it was significant in one sense, but it's not in another. The change was to add to the definition of intangible assets goodwill, going concern, other potential value, and then also make the valuation of intangibles on an aggregate basis and bring in this realistic alternatives concept. But this is already the position the IRS has been taking in cases prior to that. So it really more specifically aligns the rules with how it's already being looked at. So in some sense, not a huge change, but now it's formal, right? So now here forward, it's not going to be a way to win a court case, which the IRS had lost court cases around these kinds of issues. The other thing is IRS issued this frequently asked questions about documentation, which is a pretty practical piece from them. It's not a long publication, but it really kind of gives you some insight into what the IRS views as deficient documentation to really understand, risk assess, and examine positions. And the other practical implication of this change on the IP thing is really, well, I don't so much of a change. That's still going to continue to be one of the IRS's significant focuses in examination is IP related transactions, right? So this just sets them up to have, now the rules are more current to the position the IRS has historically consistently taken on intellectual property and kind of what's included in an intangible asset context. I think we need to breeze here. This gives some self-assessment type guidance, but I think if you really look at this, what is the IRS not like? They don't like checklist functional analysis. They don't like canned things that are just the same approach to everything. They want to be able to see that you did develop the facts and circumstances, the functions, assets, risks enough, and then tied to the why you chose a certain method, why you didn't choose other methods, why you did a certain type of economic analysis. And if you're making adjustments and changes to it, really giving some correlation to the reasoning behind that, not just, oh, we did working capital adjustments because it's a matter of course. It's just a commonplace, which it is a commonplace thing to do, right? So I think these are some things that they're pointing out where they view it as, if we had better documentation, at the beginning, we could more quickly deselect issues and not spend time looking at them or developing them, which would free up resources and keep taxpayers that don't want to be in examination out of examination, right? So in theory, that's a very good thing. We'll see how this kind of plays out. This is relatively new. So BEPS 2.0, which some people don't really want to call it that, but this two-pillar solution, this is really around that action one, digital challenges of the digital economy. So history is a lot of countries in the last few years have put on unilateral digital services taxes, which I'll explain a minute later. Currently, as of in a few weeks ago, there was some political consensus and agreement at the inclusive framework level around this two-pillar solution. And they want to have, model rules and ways to implement this by the end of 2023. What's our takeaway there? It's a very ambitious timeline. I mean, there's a tremendous amount of technical work. If you think about how do you do some of the things that would be required as far as international cooperation and in the tax context to make these things even work, even after the rules are agreed, right? And then, of course, the not insignificant challenge, certainly in the US and other places, of can these political commitments and the intent of this agreement, can this be brought into domestic legislation, or will the domestic legislation in the US be similar enough to be consistent from the OECD's view? So the digital service tax is a big thing because, of course, that it's a lot of these digital companies and these types of companies that have drawn the attention for all of this BEPS project. These are unilateral measures, which is why it's a little bit concerning. And you've even seen some US states consider this. I don't see that as at least likely very soon. Maryland did get something kind of to the point of being relevant, and they've delayed it a little bit because there's litigation happening about the legality of this type of arrangement. And I think the rest of the states that had brought these kind of bills are going to just wait and see how that plays out. So we'll just see from a domestic state level. But the foreign countries have put these in place. A lot of foreign countries have done this. What is a DST? It's not an income tax or sales tax or VAT. It's really just a gross revenue tax, right? So it's very blunt as to how it gets applied. And so to give you one example, France, they've chosen 3%. And who are they targeting? Well, that 750 million size group, and then with a combination of, you have a certain threshold of size in our country, right? But what that is based on is the definition of what those digital activities may be, which every country may define a little bit differently or interpret a little bit differently. So it's a challenging area to think about, and something that hopefully will be less relevant if this pillar one solution can work. So the two-pillar solution. So this is the thing that was recently, a couple of weeks ago, put in play. The original proposal was really tied to, it's certainly targeting these high-margin type, highly mobile multinationals with that can make a lot of money with minimal presence, right? And so it was focused on 750 million size as sort of a threshold, but it was really focused on a qualitative, what does the business do? What does this company do? Audit, is it a digital company? Is it consumer facing? Whereas this October agreement has completely changed that to be 20 billion and up revenue size at a 10% threshold of profit. So if they're above that, right? It simplifies it tremendously as far as how it impacts selection of people being in scope. It also makes it a lot less relevant to a lot of companies for the near future, though that threshold probably goes down at some point, but that's some years away. What is amount A going to be? That's there's again a lot of detail behind this, but effectively you're talking about a company that has profit above 10%, taking a quarter of that profit, that deemed residual profit, and then that's an allocable amount A. And then how do you figure out the other side of it, which is how many local market jurisdictions justify qualifying to have some share of that reallocation. So a US multinational giving over some of its taxable income to be taxed in the local country. That'll be kind of a pro rata thing once you get to who qualifies, but who qualifies is going to be tricky, and these calculations and the mechanisms for doing this back and forth is extremely complicated. Again, why it's very challenging timeline. But if you just look at this, the work that you're seeing, this might be 100 companies, although half of those are probably US companies. It is still fairly targeted into technology, pharmaceuticals, consumers as industries, but it's even more concentrated within headquarters. This is almost all US headquarter, China headquarter, Swiss headquarter companies that are going to end up falling into this currently. So not something that probably is going to hit everybody for a long time, but it is kind of the current topic of the day. And so there's been some significant move forward on that in the last few weeks, really. And in the next 2 years, hopefully, it gets all fleshed out and can be implemented. The other half of Pillar 1 was this Amount B, which is clearly a secondary priority to Amount A, but a fixed kind of safe harbor type return at that local market level, which would give companies some comfort that they're at the right level, but also gives some of these local market jurisdictions some reason to push for a minimum as well. But how do you qualify these types of safe harbors? There's a lot to be defined here, but there's listings right now in the proposed stuff around positive factors of what makes you a routine marketing distribution entity, what would disqualify you from being one. There'll be quantitative factors, different things like that. And this would presumably be set by some kind of profit-based range of comparables that would maybe take the median or some kind of thing like that, different by industry, different by region. How that gets set, who controls it, there's a lot to be worked out there. But the other piece being, would there be some kind of offset? So if you're getting this Amount A allocated to your local jurisdiction, but you also already have an entity making profit above this fixed safe harbor, should you be crediting that against? So there's a lot of places where these things have a lot of complexity in how they work together, even though in some ways they're trying to target the same policy objective, which is local market countries don't feel they're getting their fair shake from the big multinationals, is really where it plays out. I'm going to go through this one pretty quickly because it's not as directly transfer pricing, but the Pillar 2 part is this global minimum tax, right? So it's been agreed that 15% is going to be the floor. Again, we're still talking about 750 million euro companies. So there's a subject to tax rule, which is rules structured around denying treaty benefits, where an intercompany transaction is not going to end up being taxed at least the minimum rate somewhere or another, giving that local side a way to deny some of that treaty benefit. The other piece is sort of a combined pair of rules called the GLOBE rules. This income inclusion rule is like a top-up tax. So U.S. parent has a sub paying zero tax, right? That's going to get taxed at a minimum kind of level. There's some similarities with the GILTI regime, right? And we'll see where GILTI goes as well. The undertax payment rule is not meant to be some separate thing. It's really the back-end secondary offset with this income inclusion rule. If that doesn't catch you because your structure is different, or you're headquartered in a low tax jurisdiction, this is giving you that look up that the minimum tax is being paid at a parent level, or we're not going to, let you achieve that here, right? So denying deductions, those kinds of things. So everybody's agreed to this framework. Every country may not implement these rules specifically, but they're at some level agreeing that they're going to at least play by them with other countries in this inclusive framework. So, as far as just some insights, obviously a very ambitious timeline. Obviously, a lot of challenges. You're just seeing what the local U.S. legislative process is going like with anything. How are we going to layer all this in there and get it done, right? You can see where there's a lot of challenges there. I think from a transfer pricing perspective, our rules about what's arm's length and that arm's length standard will remain the same, and going forward is similar. From an income tax perspective, some of these things have significant possibilities for changing things. And there's a lot of incentive from like the U.S. perspective, let's focus on that, but other places as well, that out of the adoption of some of this, you get a little more tax certainty and some tools to mitigate tax controversy, to mitigate all these ways that this can become a challenge that where disputes are just like gridlock, right? They take forever to work out between the governments. They want dispute mechanisms to get those things resolved quicker and prevent them, frankly. The other thing being the incentive to stop the unilateral proliferation of this DST concept, right? If everybody goes and does that on their own, it's really a messy deal for taxpayers to keep up with, and it's going to be hard for this global consensus concept to function with that going on parallel. Now, that said, quite recently, there's been announced from Treasury that there is an agreement from a couple of big players, France, Italy, Spain, UK, about rolling back their DST regimes. Now, of course, the US would want to say, hey, we have this agreement, you should just roll those back. Now they're saying, well, this is fine, we'll roll them back, but we'll roll them back after this amount A is coming our way, right? So after we're getting this reallocation. So, and then there may be some crediting for that play. But again, these are really large companies with this amount A context, and the DST context is a much smaller company that's still subject to that. So there's different things relevant for different size companies. All right, really got a lot in here that I don't have time for. The COVID related stuff, I'm not going to spend hardly any time on, but what I would say is the practical thing I would take away from this is where you have impact from COVID to your transfer pricing, your operations globally, I think the most important thing is keeping detailed track of really what that impact was, what caused it, what caused your revenue decline, what caused your costs to go up, what capacity utilization changes did you have that you could quantify and very specifically explain. Because I think once we get a few years down the road, the tax authorities are going to forget, or not forget, but certainly have a lot less sensitivity to just this idea that, well, COVID happened and everything went crazy. Anything goes, right? So obviously for audit defense, I think we need to be preparing for the anticipation that tax authorities are going to view these variances from policy as things that need to be investigated. And we want to be able to very clearly show them, hey, these are real business impacts, which shouldn't be hard for some businesses, but taking the effort to really specifically do it while it's fresh, it is a very good idea. Financial transactions, this is an area where there's historically been less guidance than a lot of the other types of transactions, but somewhat in line with some of the Action 8 to 10 stuff. This really gets into specific types of transactions. And again, where you're really trying to go there is, you know, a concept of recharacterizing debt and equity, which we'll go into a little more area later from the US perspective. But where that doesn't align with the real borrower's risk and lender, would this company really act as a lender? Looking at it from both sides, you know, that's something that's up for more scrutiny. Does the interest rate really jive with the credit risks that are really in play? Certainly financial guarantees is a big area. I think we'll probably gloss over here, but you know, that formal guarantee that may allow sub to borrow more or at a better rate than otherwise, how do you share that credit or that synergy? Cash pools, you know, I think the concern from the government's perspective is this idea that you could set up a cash pool, have a synergy from a whole group, and all of the profitability from that synergy lands in one place, as opposed to the synergy was really yielded from the collective action. Shouldn't it be shared with everybody? I think that's kind of the perspective coming out of this. And then the captive insurance stuff, I think there's really some suspicion that really a lot of these were set up as structures, and they're not set up as rationally thought out entities that really can bear the risk, can manage the risk mitigation in a real way, like an independent insurance company would need to do. So kind of questioning the substance there. So again, with financial transactions, we need to be thinking about our substance around those. We need to really be thinking about both sides of lending financing transactions as to, would this make sense for both sides? Would both sides actually look at this as a reasonable deal? Which is hard in a related party context, right? But that's where a lot of the push is to say, well, really a lot of these debt or financial advances that are being called loans are really equity contributions if you look at how these parties are connected. And that's kind of one of the pushes. So with that in mind, you know, in the US, for 482 purposes, we do a lot of benchmarking intercompany loans. So what is the actual interest rate based on the credit ratings that we would assign in this controlled context? What does the market say a debt capacity could be in this type of industry, et cetera? Those are the kind of things we'll be looking at with 42. But I think underlying all of that is the more basic question of, was it debt or was it equity? And that's where the big challenge comes. And most of that is to date really been decided at a case law type level analysis. And one of the kind of the founding case that laid out a lot of these principles, there's plenty of other cases around this issue that have other factors, but the mix-in case, the mix-in factors, so they're called, gives us sort of a group of factors that would weight together. This is not a priority list. It's not a checklist of check, 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 yes, no. It is really a qualitative thing, but the intention of what the arrangement was, did you document it as a loan? Did you actually have a plan to repay it? The intention to repay it is a big underlying theme through all these. And does a given factor look more like equity, more like debt, right? So, absence of a maturity date, no documentation as a loan, not really treating it as a loan in how you account for it or how you dealt with it at the time of putting it in place. Those are things that are going to go against your debt characterization and support maybe more of an equity view. Sources of repayment, did you, if the only way this gets repaid is by liquidating the subsidiary, that starts to feel to a tax authority. That's more like an equity investment than a debt instrument. If giving this loan to the subsidiary allows you more management responsibilities or control, again, more equity type leaning than debt. So those are all factors to be considering if you're making an intercompany loan. Number 8 here, thin capitalization. Again, this is one of the very, the one we look at in 42 a lot with how do we support that with market data that the capitalization levels reasonable and arm's length, because this concept of if a borrower is undercapitalized, it just calls into question the reasonable expectation that this is going to get repaid and thus more of an equity kind of interest. And then I think there's a couple of these at the bottom where you're really getting to, if you don't ever treat it like a loan, if you didn't pay it, if you're always skipping the interest, if you're doing these kinds of things, those are things that lean it towards equity. So the further you go in that spectrum. But again, when you look at the way the court takes these, this is not a priority list. It's not, a majority rule, 7 out of 13 kind of checklist. It really is, these are the ways they're weighting the factors and not putting more conclusive weight on one than the other. And that characterization is really going to be made case by case. But I think the practical takeaway is when we're making intercompany loans, I think we can go a long way in our favor by doing our documentation correctly, accounting for it correctly, and having a plan with how we're going to pay the interest off, pay the loan back that is achievable and can actually be in substance undertaken so that we have at least those types of things in our favor. Okay, I hurried up there. I think we're coming close to time here, but last couple things here. One thing floating in the background a little bit on the loans is obviously the change away from LIBOR after all of the issues that happened around LIBOR. There was some light shined on how that rate is structured. And so it's not just LIBOR, but an interbank offering rate is, as it sounds, right? It's based on what banks would say they would lend at short term to each other. Now that has some credit risk of that panel bank involved in it, whereas these alternative risk-free rates, they're really, as they would say, risk-free. But the main key, I think, is that they're based backward looking. They're looking at actual cleared transactional data. So it's a little more transparent. And I think that's the driving factor. People want that transparency in this process. So this has tremendous implications for the financial services industry. From a transfer pricing perspective, I think the most obvious impact is, all the intercompany loans and financing that may be based off LIBOR, the practical administrative changes that might take, the accounting systems challenges that might take to not have disruptions. And then, of course, you have some of these restructuring consequences from a transfer pricing perspective of does changing the fundamental way that was done actually change the rate being paid, and then do we have to reevaluate, is it arm's length, again, that kind of thing. But This is obviously happening in mass at the end of this year, and will have already happened for most of the currencies. The US dollar has some tenors that will continue through 2023, so we have more time to get ahead of it from a US perspective, where we're using the LIBOR as a benchmark rate. Just a last quick summary for reference. I think the standard overnight financing rate is going to be one that's used a lot, but you have others. The sterling overnight rate, the Fed funds overnight index, Ameribor. But again, the common theme with these is they're based off data. They're based off of transactions that have cleared, not our estimation of what we would charge kind of forward looking, which of course conceptually does leave you with more opportunity for it to be manipulated, which was obviously the concern that this big transition is trying to mitigate against. So I think I had to hurry through, sorry to have to hurry through the COVID stuff and a little bit of the financial stuff, but I think to keep on time, we needed to do that. Ryan, were there any questions?
Yeah, Josh, we did have some questions, and thank you for the detail on this presentation. I think we may be better served just to be mindful of everyone's time as you and I get together, answer those questions directly, and then we can send them out to the group at large just to let people know. But in just for the audience, if you enjoyed this presentation and would like a part 2, as there are clearly lots more to cover on this topic, please let us know at marketing@bvccpa.com. And then I've also included a link to Josh's LinkedIn profile. So Josh, you may get a few more requests in the coming days. Josh is always willing to help and very knowledgeable in this topic, obviously. So thank you all very much for attending, and then we will send those questions, this recording, as well as the presentation materials out by email to all attendees at the conclusion of this. So thank you all very much and have a great day.